Hi everybody, welcome to another revision webcast, which this time is going to focus on a really important A2 micro topic, one of those kind of modern theories of the firm which a lot of students find really quite interesting and relevant to their studies, and that's the theory of contestable markets. Contestable market, the really key definition here is that it's a market which is basically open. It's open for trade, it's open for competition. And that competition can either be in the form of actual competition, in other words, firms that are already within the market, or it can be in the shape of potential competitors. The threat of competition oftentimes can be as important as the existence of competition. And that's going to be a theme, an important thread running through this revision presentation over the next 15 or 20 minutes or so. I think the best definition of a contestable market that I can find is the one that's highlighted on this slide. It's where an entrant, a potential rival firm, has access to all of the production techniques and technologies that the existing businesses have, and crucially that entry into the market can be reversed if it isn't successful without cost. So what are the main conditions? What are the main characteristics required for a market to be called genuinely a contestable industry? The graphic on the right gives some examples, and so too does the text here on the left. First point is there needs to be a pool, if you like, of new firms who are looking, they're willing and ready to enter the market. And oftentimes the incentive for them to do so is where the existing players are making significant, sizable, supernormal profits. Second, really crucial characteristic is the absence of sunk costs. These are costs that you can't recover if you decide to leave the market. I'll give you some examples, some exit costs a little bit later on in my presentation. Crucially, businesses in a contestable market, they need to have access to available technologies. And clearly, we live in a world where the rise of the app can often be a very disruptive influence on markets, and in many cases making it more contestable. Equally, if some firms have control over intellectual property, for example, they've patented a particular idea or a process, well, that can act as a barrier to contestability. Another key feature of contestability is that the consumers in the market, the buyers, they are willing to change their supplier to a high level. We call this a low level of customer loyalty or a high rate of customer churn. Think, for example, about how often you might change your bank account, or you might change your favorite brand of clothing or coffee. When consumer loyalty in the market is low, we're more likely to get a contestable outcome. And all of the other barriers to entry in the market, they have to be relatively low. For example, there could be some legal barriers into a market. If they're not particularly high, that makes the market more contestable. Now, what's really important, I'm going to focus on this for the next minute or two, is the nature of costs in a particular industry. This is going to have a big bearing on the degree of contestability. In this diagram on the left-hand side here, I've drawn a long run average cost curve where by the time we get to output Q1, the minimum efficient scale has been reached. And that level of output Q1 is fairly low, suggests that the minimum efficient scale is a very small percentage of total market demand. And in theory, that should mean there's scope for many firms to reach that point within the total market size, and therefore the market is likely to be highly contestable. The key takeaway point here is when a contestable market is, when the minimum efficient scale is low, the market is more likely to be contestable. Contrast that situation with this situation here, where the long run average cost curve continuously falls over a very large range of output. Now, this is typically associated with a market structure known as natural monopoly. There will be extensive internal economies of scale available to existing established firms. Firms operating at Q4, for example, can operate on a much lower unit cost than a firm, perhaps a new entrant that comes in at output Q1. So again, key point from revision: when economies of scale are substantial and significant, when the minimum efficient scale is high, other things being the same, that makes a market less contestable. And the other thing to note about these two diagrams is that the nature of costs actually is so important that government policy towards an industry to try and make it more contestable, it can't really do much to change the nature of costs. What does change it is the pace and the impact of new technologies. For example, a new supplier could come in with a significantly lower marginal cost of supply, make an impact quite quickly. Now, all markets have the potential to be contestable. That's why this is one of the most modern theories of the firm. In reality, very few are perfectly contestable. Crucial point is the degree of contestability does depend on the structure and the nature of costs in the industry, including sunk costs, and also the degree or the strength of consumer loyalty. Let's look at one or two real-world examples, the sort of data that you might be given in an exam question and asked to think about the nature of cost, barriers to entry, and contestability in a particular market. This is one of my favorite charts, updated for 2014. It shows the market share in the United States, the world's biggest market for carbonated soft drinks. And it should be pretty clear here that three businesses, Coca-Cola, PepsiCo, and Dr. Pepper Snapple, they account for pretty much 85% of the market. Now that figure has declined a little bit in the last 10 years, but not substantially. This is clearly, effectively, a duopoly with two firms taking 70% of the market. It's clearly an oligopoly dominated by three very big transnational corporations. This is not a market which is very contestable. New products can come in, new brands, new tastes, new designs, they can come in. There could often be more localized contestability. In a particular city, for example in Edinburgh, Iron Brew could be more popular than Coca-Cola. But if you take the American market, this is an industry where the economies of scale, the brand loyalty are so significant that contestability is going to be limited. Another interesting market is the drugs industry, the pharmaceutical sector. Now, this chart actually looks at what's called generic drugs. The generic drug is a medicine which has a generic name. And often the patent for a particular drug has expired. Patents typically last between 12 and 20 years. And then it's really a battle within the market to sell brands of a drug whose patent is now widely available. A really good example would be paracetamol. That is the generic name for a particular type of painkiller. Of course, within that, you have a whole wide range of brands, Panadol, Calpol, etc., which are competing for customer share. What's interesting, actually, is that this is a market dominated clearly by some very big pharmaceutical companies, but actually the market at the retail level is very contestable, particularly if pharmaceutical companies, such as they're shown in the chart, are producing and then licensing their drug on behalf of, for example, a retailer. So own brand drugs increase the contestability from the consumer point of view. Typically, generic drugs such as these are cheaper than the branded drugs for which patents have been applied for and gained. Mobile phone industry is another oligopoly where there are some significant changes. If we go back to 2009, Samsung and Nokia had over half the market for mobile phone sales globally. That share is now down to just over 30%, largely explained by the collapse in sales from Nokia, now bought by Microsoft. Look to see in 2013, 2014 how the shares are changing here. We see the rise of Chinese companies, Lenovo, Huawei, rise of LG and clearly Samsung from South Korea, the virtual disappearance of BlackBerry, Research in Motion. And this is a market where there is significant market power, huge businesses, but actually it's pretty contestable. In fact, you could probably argue this is a good example of a contestable oligopoly. In the UK, a little closer to home, probably a good example of a market with high contestability is the retail market for coffee. Leaving aside the free coffee you can get from Waitrose and from other supermarkets, what's been interesting in the last 5 years has been the dramatic growth of coffee stores generally, and the rise to prominence of Costa Coffee, which is owned by Whitbread. But Costa Coffee now has twice as many coffee outlets as does Starbucks. Clearly those three, Caffè Nero, Starbucks and Costa, are well ahead of the rest. But there's a lot of contestability at local level, particularly if you still have independent stores or brands such as AMT Coffee, which typically you find in railway stations. Costa has been one of the big success stories in the last 5-10 years. The number of shops it has is now approaching 2,000, and they are clearly a big market leader. However, the theory of contestability says that they have to think about actual competition day in, day out, often very localized, and they still have to think about the threat of potential competition going forward. The other aspect, I think, which is probably worth mentioning just before we look at the theory, is the rise of disruptive businesses. Businesses such as Uber, the taxi company, and Airbnb, the hotel or the room sharing business. Dropbox, online file synchronization services, etc. Now, those three are really good examples to use in an exam of businesses which have basically come from nowhere. Uber is challenging the monopoly power of taxi companies in many major cities around the world. It's creating a lot of disruption. Airbnb is without question a creatively disruptive challenger to the existing monopoly power of many well-established international hotel chains. By some estimates, it's now worth more than Intercontinental Hotels, which has been around over 100 years. So those are some examples of industries where contestability is a factor. My last example for you this evening is the fast-changing world of grocery retailing in the UK. I'm sure many of you follow this. This is a favorite sort of case study taken by A2 micro students. Tesco's share is now well below 30%, but it's the market leader. Asda and Sainsbury's are battling for second place. Morrison's is struggling essentially to hold on to a double-digit market share. The Co-op has been through its own problems. If you've been following that, you'll know. And Waitrose actually has been pretty steady at around 5% of the market for some time. But the next two, Aldi and Lidl, they have seen significant market growth. Indeed, Aldi, according to this chart, has just overtaken Waitrose in terms of the grocery market share up to the end of March 2015. The UK grocery market is undoubtedly becoming more contestable. It's a really good example to use. I think a little bit of perspective might be helpful on why that's happened. Lidl and Aldi are two German of rapid organic growth, opening a huge number of new stores, not just in the UK, but across Europe. In fact, Aldi is now the world's biggest, what's called limited assortment grocery. We'll come on to what that means in a second. 60 billion euros worth of sales in 2013. That will be substantially higher, clearly, this year. They have over 20,000 stores across Europe, USA, and Australia. Lidl is present in 26 European markets. And keep in mind, there's only 29 countries, 30 countries inside the European Union. 2 points I think are worthwhile in terms of thinking about the rise to prominence of Aldi and Lidl and the concept of contestability. One is that these discounters, they're sometimes known as deep discounters, these companies, essentially, the majority of the things they sell are own label. They're not going to sell a vast number of brands. That means they're going to be buying in bulk from manufacturers, food processors, and what have you. And that gives these companies huge monopoly power, buying power, which brings down their variable costs and clearly allows them to price more cheaply than the big supermarkets. Second thing, of course, is that the way their costs are structured makes quite a big difference. If you go into a typical Aldi or Lidl store, the range that a food manufacturer might be asked to supply is much more narrow, perhaps half a dozen products compared to more than 2 dozen. So Aldi and Lidl are going to get the producers, the manufacturers, to bring down their unit cost by just focusing on selling a lot of a limited range of products. This is the strategy, together with aggressive pricing and successful location of stores, which is making a big dent in the market share of the existing established grocery giants in the UK. This is a story which is going to run and run, and it's well worth following. Let's move on a little bit to the concept of how you show price and output in a contestable market. Now for A2 micro, everybody, it's incredibly important. It's incredibly important to be able to use the ideas of economic efficiency when you're drawing your analysis diagrams. If we think about contestable markets in generic terms, the more contestable is the market, it's more likely that we'll get an allocatively efficient outcome, where price is closer to marginal cost. The threat of entry, the threat of new firms coming in, is said to affect the actual conduct of firms in the market. And that's a really important point to stress in a contestable market. It's not just who's in there competing with you, it's who could be a threat in the weeks and months and years ahead. So let's look at how this might work in a diagram. Typically with a contestable market, you're going to draw a downward sloping average revenue curve, the marginal revenue curve that goes with it. I've drawn on this first slide a fairly standard profit maximizing output of Q1, which gives a healthy level of supernormal profit shown by the shaded area. Price is greater than average cost. The firm in this market is making super normal profits. And of course that sends an important signal to other firms in the market. Now, is that price and output likely to persist in a contestable market? And the answer is no, because if you're making a level of profit shown in this shaded area here, that is going to be a significant incentive for new firms to come in. And if you want to prevent those new firms from entering, you're likely to have to price lower than P1. P2, for example, would be a price which allows it's a limit price, which means you're making just normal profit in the market. And that could be sufficient to keep you in the industry. It might also be enough to prevent a new firm coming in. So what are we saying here? We're saying that in a contestable market, the price and output you might get, it will be somewhere between the profit maximizing output shown here and the normal profit equilibrium shown there. There's no one single price and output combination. Don't necessarily have to maximize profit in a contestable market. Many firms are revenue maximizers. You maximize revenue when marginal revenue is 0. You still can make some supernormal profit. The output here shown in the table, in the chart, you can still make some supernormal profit. And again, you may have to price lower than that if you want to prevent a new firm coming in. Let's now move on briefly to the barriers to contestability. What stops a market being contestable? I think you'll know from what I said a few minutes ago that the crucial point is the nature of costs. When economies of scale are huge and significant, it's much harder for new firms to come into the market. Second barrier to contestability is when the firms in the industry have control of the supply chain. So typically we associate that with industries which are vertically integrated. They have control from factor resources, extraction, processing of resources, through to manufacturing, distribution, and final retail. In vertically integrated businesses, it's harder for the industry to be contestable. Markets are less contestable if there's significant brand loyalty. And that's particularly the case with consumer products such as technology products, laptops, smartphones, etc. A market is going to be less contestable also if the existing players have control of important intellectual property and other technologies. And crucially, And this is the bottom slide here, bottom picture in our slide. A barrier to breaking into a market is often biggest because the existing firms have built up some expertise. We call this learning by doing. And vitally, they've built up a reputation and a goodwill with consumers, which makes those consumers reluctant to change. Sometimes in a market, contestability is limited by legal entry barriers. The taxi market is quite contestable, but it may be prevented from being so by the regulation of a local or a city taxi market by the issue of licenses. Patents provide legal protection of ideas. The state may protect an industry through franchises, for example, the National Lottery, and import tariffs and quotas and other forms of non-tariff barrier can also act as an impediment to contestability. Briefly, something on exit costs. Exit costs are associated with the cost of leaving an industry. They're linked very closely to the idea of a sunk cost, which is a cost that you can't get back in whole or in part if you decide that the market is not working for you and you're going to leave. Here are 3 examples of exit costs. Typically, if you leave an industry, you may have to write off the value of your assets. That could be buildings, it could be machinery, it could be stock that has to be sold at a deep discount. If you leave an industry, then you may suffer reputational damage or lost consumer goodwill, particularly if consumers have bought your product and no longer can get replacement parts or consumer service once you've decided to leave. And thirdly, if you decide to close down or leave an industry, there are often quite significant redundancy costs associated with laying people off, the redundancies being a natural feature of closing down. Finally, let's look at how policies can make a market more contestable. This is a favorite exam question and one that's worth looking at. I'm going to suggest that there are essentially 4 main ways that you can make a market more contestable. First is when the government, through its competition policy, decides to deregulate an industry. In other words, they strip away some of the legal barriers to entry that had existed before. And I think a really good example of that, which is probably more than 10 years old now, is the very competitive, highly contestable market for parcel deliveries in the UK. Yes, some businesses come and go, some fail. But if one looks at this graphic here, in the UK parcel industry, there are many, many significant players. Parcel Force is the big one, owned by the Royal Mail, but many others, DPD, FedEx, UPS, TNT, these are significant players. And the parcel industry in the UK is now one of the best examples of a highly contestable market. Second option, particularly if you have an industry where there are significant economies of scale, is for the competition authorities, or the industry regulator, to insist that the existing monopoly opens up its distribution network to rival firms. This is sometimes called the final mile issue. BT, for example, has a huge, well-established and expensive network of fiber optic cables and boxes and transmission devices which link to the final mile, the consumers around the country. And the Ofcom, the regulator, has insisted that telecoms firms are allowed into those telephone exchanges to put their own cables in to offer competition to British Telecom. That's a good example of how you can make a market more contestable. Thirdly, you can be pretty tough on aggressive predatory pricing. Predatory pricing is when an existing firm deliberately prices below cost, either in one market or across a range of sectors, in order to inflict a loss on a competitor so as to force them out of the market. A recent example shown here is when Whistle has criticized, Whistle is the TNT parcel delivery, letters delivery company, trying to compete with the Royal Mail in delivering letters to households and businesses. They decided to close down their operations in Manchester and Liverpool and London. And there's some feeling amongst the Whistle executives that actually the Royal Mail may have been engaging in some predatory pricing style behaviour to force them out. But as yet, no case has been brought against the Royal Mail. This is purely an alleged idea that Whistler has taken as it's left the market. And the fourth way to make a market more contestable is to open up your domestic economy to trade. Bringing down import tariff barriers and other non-tariff controls is a way of opening up a domestic market to create more competition. This would be a good example of when a supply side policy at a macro level has an important supply side effect, competition, contestability impact at a micro level. China lowering import tariffs for a large range of consumer goods and services is a way of inviting overseas suppliers into the Chinese market. And that's designed to make their consumer markets more contestable and hopefully bring prices down. So these are some of the ways in which it's possible to make a market more contestable. But keep in mind that perhaps the biggest influence is the way that technology is opening up markets, and in particular it's allowing smaller, disruptive, creative and nimble firms to break into segments where they think they can make some money. So what are the key takeaway points from this presentation on contestable markets? This is a very popular topic, and it's an important one for A2 students. The first point is that the threat of competition can be as powerful an influence on the behavior of firms as the existing firms, the threat of competition. Secondly, if a market is actually contestable, if it's contestable, and we've seen some examples in this presentation, the industry structure and the behavior of firms is determined by that threat of competition. We talk about something called hit and run entry, where new firms take a punt and try and break into a market with a slightly different product and hope that their product is successful. If it doesn't work, they can leave because the sunk costs are low. Perfectly contestable markets or highly contestable markets appear to be like perfect competition, but they're not perfect competition. For example, the demand curve for each product is downward sloping. But a highly contestable market will be similar to perfect competition, actually regardless of how many firms there are, because the threat of competition and actual competition causes what we call the incumbents or the existing firms to behave when they're setting their prices and their outputs as if there was intense competition. In many markets we've seen tonight, there is significant contestability, even if also we have several firms in there with very large market power.